fourth quarter of 2016 was another disappointing year or disappointing quarter for South African equities, concluding a disappointing year as well, with equities really delivering just over 2.5%, which was below inflation and below cash returns. In fact, for the second year in a row. I think the factors that really weighed heavily on the equity market this past year was the strong rand, which impacted some of the dual-listed stocks like British American Tobacco, like Richemont and South African breweries until they delisted. If you have a look at the area of the market that obviously did exceptionally well, it was resources. I think as a fund manager, if you weren't invested in resources, it was quite a tough period. If we look more specifically at the fourth quarter, there was a reasonable amount of good news, obviously. South Africa not being downgraded or managing to avoid the downgrade from S&P. But despite that, there was still a lot of volatility. I think the US elections really set the cat amongst the pigeons, and on balance were actually negative for emerging markets, including South Africa. So our clients' portfolios had another good quarter, ending what was a very good year in 2016. I think our focus on identifying mispriced opportunities, as well as adopting a fairly defensive or conservative approach in the way that we constructed our portfolios, meant that the fund was able to withstand some of the surprises that were thrown at us during the year. Particularly if I look at the areas that contributed quite nicely in the quarter, it largely came from some good stock picking. Some of the counters like Barlow World, Hudeco, Investec, and in particular the big one was Altron, which we've identified in the past as being a really significantly mispriced opportunity. And that started to come through quite nicely, and we still think that there's a lot more to come. So we've had 2 years now in which equities have underperformed cash. The last time we've seen this was probably the mid-1990s. In fact, there's only been 3 periods going back to 1960s where you've had 2 consecutive years where equities have underperformed cash. The interesting thing is that in the period following the year in which cash beat equities, you tend to have very good returns from the equity market relative to cash, with equities outperforming on average 18% in the year following those sort of 2 consecutive years of underperformance. And that is double the average outperformance of equities versus cash. That, together with the fact that the valuations we see today are the best that we've seen in 3 years, the 12-month forward PE sitting at around 13 times versus 16 this time a year ago, does bode well, or bodes better at least, for expectations for equity returns. Having said that, though, there are a lot of macro events which I think could potentially weigh on the improving fundamentals that we're seeing. Our approach is always to focus on bottom-up stock picking, and we still see a number of very attractive opportunities, particularly in the mid and the small cap space, focusing largely on South African domiciled businesses as well.